For today's video, I've prepared a presentation about the shipping company Maersk. It's actually the world's biggest shipping company. First of all, we're going to talk about the business model of Maersk. We're going to move into the ocean business and talk about the logistics and services business, talk about how they're investing for the future, ESG with the environment and the social governance, all these things, risks with Maersk and share buybacks, dividends, fundamental summary, future growth opportunities, financial position, and then the 8 criterias. And last but not least, we're going to take a look at intrinsic value. What is the intrinsic value of Maersk? What should you be paying? And we're going to use this little intrinsic value calculator for that. Without further ado, let's get right into this one. Maersk is a kind of complex business. There's a lot of parts to it because they offer a lot of things essentially. So we can see if we start with like the chain here, essentially they have a destination. They deliver their the goods to like a space where they can store them, and then they get taken to a terminal. Then it either gets loaded onto a huge container ship or a train or an airplane. And essentially they have another import terminal, taking it and then bringing it to their warehouse and distribution places, and then bringing that to the customer. To show you like the complexity of Maersk as a business, right? I have this company overview here from 2015. So these are all the businesses that Maersk has stakes in, and you can see they have 100% of all of these in the top here. So essentially 12 pages of all of the businesses that they own. And you can see here in the top we have a lot of, we have pipelines and we have a lot of terminals, and that is just all over the world, right? And that continues down here a bit. But then we come down here and we have some logistics businesses that they also own in all sorts of countries. We have some holding companies also, and some I think actually container manufacturers or whatever that is. Drilling here, they have Maersk Drilling, which is a company that actually spun off Maersk, but then they own the entire thing, so that doesn't really matter. They get all of the profits from that. And you have to understand, right, with boats they use a lot of oil, and that is why it's not the most environmentally friendly company, and that's why on the channel here we talk a lot about environmentally friendly investments. But with this one you have to think about in the context of the entire sector, right? You have to think about what are the other options, because your things have to be transported, and no matter what you have to go with like either one. There are of course competitors to Maersk, right? And they're just not as big, but you have to see who are actually the most ambitious in regards to hitting the environmentally friendly, hitting their goals for the environment and hitting net zero emissions and stuff like that. So we're going to take a look at that. But they have all these drilling, and that is of course oil. They also have oil down here, oil, and they're kind of self-sufficient in their business model. They make a lot of the things that they use themselves. They have Norway, Maersk Norway, and it just continues down here. Supply, services, supply chain, shipping. They also have insurance companies. So yeah, these are like stakes that they have in businesses. But yeah, so 12 pages with just companies that they own, right? So now you have an idea of the complexity of the business model, and you hopefully understand a little bit about what they do. So let's continue here. So the ocean business. I read the entire annual report for 2021, and in that they talk about their different businesses that they have. They have their ocean business, right? And essentially you can see the profit EBIT margin. So that is another term for some kind of profit that they like to use in regards to Maersk, because in one business you might use cash flow, and in another you might use your earnings. But there's differences because investments go into one or the other, and essentially for Maersk we use EBIT or EBITDA to determine the profitability of the business. And you can see the EBITDA margin here is, they have a target to have that greater than 6%, but that has been the past year 37.2%. So yeah, and that was only 11% in 2022. So the year before that it was only, it's basically over tripled. So that of course brings up the profitability of the business 3x, right? It looks like it's been some very great years, and something that I really want to, through this presentation, I want to remember to look back into history before the whole world changed, right? What were they doing back then? Because those are really the numbers we can rely on. So the ocean business, that is the main driver of their earnings. Something that they weighted in the report is increase in long-term ocean contracts. So essentially how it works is they have contracts with different companies that has to have some things shipped, and then the companies buy container room on the boat. So there were increase in long-term contracts, which is kind of the way that this ocean shipping is moving towards, and and they already have a significant portion of long-term contracts, and that is increasing also. So that is really good, because something that, you know, we saw the margin expanding 3x the past year, and what you have to remember with when something suddenly becomes a lot more profitable, a lot more competition is going to come up. So for example, with the cloud computing, we've seen like everyone does cloud computing now because it's 80% gross margin, easy money, easy to do. Everyone does it now, right? And all the big businesses does it because it's just an easy way to make extra money. But as their competition grows, the margins are going to drop because it's going to get harder to acquire customers. It's going to cost more, and the overall cost is going to go up, and your margin drops. So it's going to be interesting to see how right now there's a lot of demand and not a lot of supply. That is why the margins are high. But naturally, the supply is going to, you know, increase also. When the demand kind of slows down, then we have a lot of supply and just not a lot of demand anymore, and then they kind of meet ends, right? And what is going to happen with Maersk then? Are they going to be, you know, out of business? Probably not, because we're going to get into that. But essentially, we can't know the future, and so this is a very good thing that they have long-term contracts, because, well, then they have secured the customers, and also they right here. They say contract customers drive organic growth through the offering of end-to-end supply chain solutions. So what they are really focusing on, which is this logistics, that is the next slide, but they're focusing on delivering every single step to the customer. They want to be able to take it from, you know, somewhere in China where it's getting manufactured, deliver it right to your door. You don't have to, you know, touch anything. It's just all done for you. And you know, when they have this long-term contract, it's easier to get their customers to participate in, for example, the logistics and services that they also have. As they state in the report, this logistics and services business is going to be the core growth element of AP Møller. And as they write here, they seek to fulfill more of customers' needs every step of the way. So, you know, right now, here are some things that they offer. Consolidation and deconsolidation is basically where you take things, you know, you have a customer, they have a factory, a couple factories in China, and then you assemble the things for them basically into one place where it's going to be shipped from. That is consolidation. Deconsolidation is where you basically do the opposite. Really hard terms here, I would say. They have fulfillment, warehousing, distribution services, depot operations, and e-commerce logistics. This, as they state themselves, is going to be the main driver of growth. It's not going to be the old school ocean business, which is, you know, in the back just driving the profits of the business essentially. This is like the goals toward 2025. The EBITDA margin is supposed to be greater than 6%. They have a goal for their revenue also here. Organic growth, right, is going to be above 10% a year. So that is a lot higher than we will take a look at the growth for the overall company. But, you know, essentially last year it has been 34%, but over 10%, that is a lot higher than the entire business. So this is going to be the driver of growth. Something that I think is very interesting is, after a good year like this, we've seen a lot of companies who have benefited from this whole situation just pay out a fat dividends of, like, you know, 20%, and then that is good, and then we are over this and we're moving on to next year. We've seen a lot of companies do that, but Maersk is not doing that only. They have also paid out a fat, like, 11% dividends, but that is still only like 40% of their cash flow or something like that. So what are they spending the cash flow on? We can see here in the cash flow statement that they used billion US dollars for reinvesting activities. 8 billion. And they paid out distributed dividends, 1 billion spent on dividends. So they only spent 1 billion on dividends, and they paid out at 11% dividends or something like that. When they stop investing into the future and only start paying out dividends, they're going to be able to pay a fat dividend. But I like to see that they're still focusing on the growth element, because there are different areas, there are different like periods for business, different like on the timeline, right? It starts out a lot of growth, easy to grow. Then the company becomes so big that it's essentially harder to grow, and then they focus on bringing the value to the shareholders through, repaying dividends. And that is essentially the only way that you will ever get value as a shareholder, is through dividends. The capital gains, your asset going up in value, is only because the dividends, the dividends or the possibility of a higher dividends is there, so people want to pay for that. We want to make sure that we can get a nice dividend either now or in the future. The fact that they're investing this is just showing that they think that they can grow the business even more than it is already huge, right? They think they can grow it even more and essentially in the future create even more value. So I feel like it's great that they are doing this. They're of course spending a lot on reaching their goals for ESG, which we'll look at. They're investing massively into the future. Still, they're buying back 2 billion worth of shares and 1 billion distributed through dividends. So this is the greatest combo of all time, I feel like. We have a nice dividends, right? A great dividends and they spend twice as much buying back shares, which is giving you a bigger ownership of the business. So essentially, in the future, you're going to get even more dividends. So that dividends, buying back shares, plus still investing. So a lot of companies just do the two of them. But the fact that they're still investing means that they also will be able to increase the dividends in the future, and you have a bigger ownership and you get a dividend. It's just, it's great. They have a goal to keep their return on invested capital, which is, when we invest into the future, they invest in 8 billion here, right? What return can we expect from that money? So if we look at here, the return on invested capital, underlying return on invested capital, the past year has been 45%. But if we go back, it has been very, very low and very, very poor. We want to see this above 10% usually. 3%, 1%, 3%, 9%. It has not been great, to be honest, right? And they have a goal to keep their return on invested capital above 12%. They state that they're going to be able to generate 12% return on the investments coming into the business through debt and equity. And essentially, this is 8 billion going right into the investments. So we would like to see a return on that. And if it goes back to like a 1% return, that is not really nice, right? We want to see this 12% return. So that could be great if they could do that. But now we're heading into other territory, which is the ESG. So ESG is environment and social and government. So we can see here, this is mostly just regarding the environment, and essentially they have a goal right here. By 2030, they pledge to be the industry leading in this green customer offering across the supply chain. They want to be like the leading in that. By 2030, they also want to be in line with the target towards 1.5 degrees global warming. And by 2040, which I think this is the really big one, net zero emissions across the business and 100% green solutions to customers. I don't know how they're going to do that, and that brings me into like that is 18 years in the future, right? But 18 years for this huge company, which have, I don't even know how many ships actually. I should probably have looked that up, but so many oil-eating ships, right? How are they going to do that? I don't know. But that brings me into the risk section here, which is what risks are there, and these are some risks that they state themselves. Of course, there's some general ones that they have to state, like legal things, ocean industry collapse. I don't know why that should happen. The only thing that I can really think of is like we not needing to ship things anymore because we have like a printer that can print clothes and meat and books and everything, or we have ebooks maybe. I don't know. Yeah, so there's a possibility for that. Of course, a huge risk there if that happens. I don't know if that is even going to happen, but yeah, they're not able to deliver the service level that they need, and yeah, we have the big one here, decarbonization, which I think, failure to decarbonize AP Møller-Mærsk end-to-end supply chain and at a speed that meets investors and customers' expectations. That is a huge one. They have 2040, 18 years to decarbonize this incredibly big company, and if they don't do that, well, we're going to see some some headwinds, I would say that. Another risk is what we've already talked about, is the EBITDA margin decreasing. It has been incredibly high, 40% almost. Where is it here? 40% almost EBITDA margin. If that lowers, well, it is going to lower, but how much and how is that going to affect the whole scenario? And we have the big one, because EBITDA is expected to decrease. Return on invested capital, I don't know how much people are thinking about that, but if they can't, so yeah, we have a return on invested capital after tax looks even worse than before, actually almost 0%, 3%. So yeah, that looks pretty terrible history of return on invested capital that they have. If it goes back to pre-pandemic levels of return on invested capital, that's not going to be great. So those are some risks, which is really important. That is the most important thing when you're looking at a company, looking at the risks. Just look at all the bad things, all the people who are negative towards a company. Listen to them. That is the most important thing you can do. Listen to all the haters, guys, because most of the time they don't have anything. Like, if you set your mind on Maersk and think it's great, and you actually have done your research and you're good at it, most of the time what they're saying is going to be like complete crap, right? It's going to be nonsense. But sometimes it's going to be some legit things that the haters say. So that is the most important thing. Share buybacks, guys. This is incredible. Look at this. They started a program 2022 of 1.6 billion. In May they started another program, 2021, $5 billion, and extended that with an additional 5 billion. So essentially they have committed an entire $10 billion US dollars to be to buy back shares in phases during 2022 to 2025. In the next 3 years, they're going to buy back, at the current market cap of 55 billion, they're going to buy back 18% of the market cap. That is insane. In 3 years, guys. If you look at that, right, and you also look at, you get a fat dividends, right? And maybe not a fat dividends, but like, let's say you get a 3% dividends. 3% dividends, and they buying back shares, you can reinvest that dividends, get a bigger ownership stake that way, and at the end of the day, in like 10 years out in the future, you could be sitting with a lot, with getting huge amounts of dividends from your investment, from your little investment compared to what you're getting. So essentially, buybacks are really the bread and butter, man. But dividends, of course, the reason we want these share buybacks is to give us a bigger ownership of the pie. If a company has 10 outstanding shares and we own one of them, you own one of them, whatever, you own 10% of the business. But if they buy back 2 shares, you still have that share, but that 1 share, but that is now 12.5% of the business. So that is what they're doing. They're buying back the shares, and they're doing a great job of that. So yeah, we want that to get a bigger piece of the revenue and profits, which is paid out through dividends. So we want a bigger dividends. The past year, they paid out around like 10 to 12% dividends. If obviously the stock price varied a bit, but and they have a rule here. They pay out 30 to 50% of underlying net result. So that is a healthy payout ratio, 30 to 50%. That is usually what we look for. So that is great. And then they have an unstable dividends track record, which is here we can see from this graph of their dividends. It has been laying at around like 1 to 2%, and the past year it bumped up to like 11%, and they are forecasting it to go even further up to like 14%, and then down to 8%, and then down to 4%. So yeah, you could just buy some Maersk and then just hold it for the dividends. But of course, these are analyst expectations. But definitely they have had a great year, as I could read in the filing, right? They have had a great year. Also, a first quarter has been great, so it looks like this year is going to be even better than last year. And yeah, I don't know. So essentially, last payout was 33% of the earnings. So healthy and well covered by their cash flow. Fundamental summary. Now we're moving into like tearing the business apart. So I'm just going to switch the camera battery here. So the fundamental summary, essentially these are the ratios, the price to earnings and price to free cash flow. So we have, let's look at it. Here you can see the price to earnings of 2.6 times price to earnings and a 0.8 times price to sales. So you can see that is essentially how long does it take, how many fiscal years does it take for them to make up the entire market cap. So they make up in revenue, they make up the market cap in like under a year. With the price to sales, their earnings, that takes them 3.6 years. So really low ratios here. We have that's also much below the industry average, which is around 5 to 8 times. For the what I like to look at here is because the past year has been tremendous, and of course their earnings have like tripled, quadrupled, whatever. And when you see the earnings quadruple, you obviously don't see the stock. So just because you see the earnings quadruple, right? You don't keep. Often what happens is the PE ratio gets lower, right? Because the earnings 3x, but the stock price doesn't 3x. And the reason that the stock price doesn't 3x is because there's obviously an expectation of these earnings to drop again. So if the earnings were going to stay like this for forever and grow at the same rate that they were going to previously, then we could see like a 3 times the stock price also. But there's an expectation of this ending, and that is why we have a very low price to earnings right now. If you look at the historical price to earnings, this is a 5-year PE, but they have some negative years where their EPS was negative. And also with the cash flow, they also had some negative years, but it was simply impossible to calculate. So I had to take just 3 years and pluck them out of there, the 3 positive years out of the past 5 years, and that gives me about a 9 times price to earnings. But it's not that good looking. So so the price to earnings has been ugly, and you can't really calculate the 5-year PE actually. Price to free cash flow has been 13x in the past 5 years average. So 13, let's just keep that in mind for now, and we're going to use that when we are using the intrinsic value calculator. So moving on to future growth. This is a chart of the cash flow and the earnings and revenue growth, and that is the past, and here are the forecasts for the future. So it's going to get a little bit higher in the next year here in 2022, and then it's going to go down. So essentially what analysts say is to the next 1 to 3 years, which is 3 years, it's going to decline their earnings by an average of around 60%. So for the next 3 years they're forecasted to decline, and the question becomes, when they decline, what level do they decline to, right? Do they stop declining here at 3 years, because that is what analysts say, or do they just go back to pre-pandemic earnings, which is $1 billion a year in earnings, or do they stay at 5 billion, which is these earnings right here? That is the big question, right? What is going to happen in the future? And it's very, very hard to value a company like this, because their earnings has been all over the place and you have no idea what's going to happen. But we're going to try our best. So you can see here that in the short term, their liabilities, the assets cover their liabilities, and in the long term, the assets also cover their liabilities. So that is great, all looking good there. But in regards to the cash flow, right? The past, if you look at the debt in regards to the past year cash flow that we've seen, it's no problem. But they have a lot of debt, this company, and that's because they're buying ships, right? And they use debt to buy those ships. And if you look at the 5-year average free cash flow, which has been 4.39 billion, that is not if you take the total liabilities and divide them by the 5-year free cash flow average, you get 6, and we want that lower than 5. That basically means an average year of their cash flow. How many years would it take for them to pay out their entire liabilities? And you can see it takes 6 years, right? We would like that to be 5 years or less. So it takes a long time for them. The reason that they have taken on more debt is because that they are making a lot more money now. So I think they will scale back the debt when the earnings in like 3 years, when the earnings are back to like 4 billion free cash flow a year. If that, around that level, they will probably have less debt at that time. So right now they have a lot of debt because this rapid increase. So we probably shouldn't take the 5-year average. We should like take the past year where they did like 20 billion in free cash flow, and then obviously that is no problem covering this. So yeah, for the 8 criterias, which is something that we would like to all have green check marks here. So essentially I have 8 criterias right here. So I plotted in Maersk here, and we have a PE of 9, so that is green. We want that less than 20. I would say that's a bit hard to calculate, so that is maybe a bit generous, but we have a return on invested capital of an average 12% over the past 5 years, so that's greater than 9%. We have revenue growth, we have net income growth, we have shares outstanding increasing, staying the same, actually decreasing. I don't know how much, I couldn't find out, but they have been decreasing. And we have the only X here is the debt level is very high when you compare it to the average cash flow. So if they don't scale back the debt as the cash flow and earnings drop, then we have an issue. But there's a story behind this one, so I wouldn't really think too hard about it. They have cash flow growth, and they have a price to free cash flow under 20 at 13 times. So looking pretty good here, to be honest with you. But let's head back into, so that was all the 8 criteria. We have only one X, which is this one here. But now it's time, guys. It's time for the intrinsic value calculation. I have already plotted in some things here, and let's head to the future growth, because that is where we're going to start off. Plotting in our growth numbers. How much is this cash flow going to grow, and how much do we start at? So essentially, it's very hard to when we have declining earnings for the next coming years. Normally we start with a number of EPS or earnings, what they're doing right now, and we grow that into the future by, like, let's say 5 or 10% every year. That's of course a lot for this company, but we can't do this here because for the next couple of years it's going to decline. So what I have decided to do is take what analysts are expecting for this year right here, 3 years into the future. They say it's going to decline for the next 3 years. So let's cut all of that out. Let's say that is just a bonus. It's obviously going to be a lot better earnings in here the next like 1 to 2 years than the third year, right? It's forecasted to decline. So obviously, let's cut all this out and let's be conservative, right? Because we don't want to over exaggerate how much they're going to make. We would rather undercut that. So the number here of free cash flow is forecasted to be $5.6 billion that they're going to make there. So essentially from there they're saying now it's not going to decline anymore, now it's going to increase, is what analysts are saying. So now we have to put in a growth number, and we saw, they want their and they're saying that they want their logistics to grow 10%, and the average growth of the economy is 4%. So let's say they're going to be able to grow a little bit less than that because it's a humongous business. Let's say they're going to grow, 2% a year because they are investing. So they're not going to stagnate completely. I don't think they're going to do that, at least. So now we have the growth sorted out. We have cut out these years of good growth, which is also dividends and reinvestments and all things that we, good things that we have there. So I'll already say now we are going pretty conservative here, which is good. We have a growth rate of 2% over, every single year here, and then we have a discount rate, which is basically the desired return that you want every single year. And you could get 7 to 9% in an ETF. Investing in an ETF, this is obviously more risk you're taking on, so you want a higher percentage, and here we're going with 12% every single year that you're going to get. So that is higher than what you're going to get in an index. And then we have the multiple, which is basically, in this case, the price to free cash flow, which, that was 13. What is it going to be now? Because the company is going to be a lot bigger in the future. So it's probably not going to be 13, because if it was 13, well, we are undervalued. But let's say it's going to be 10 in 3 years. In 10 years, sorry. And we have a discount of 12. And essentially what we do is these are all the growth numbers growing with 2% a year. And then we discount that with the discount rate, which is the desired return. So we have all of these, and we sell it for the last year's cash flow times the multiple, which is 10. And then we add all of these numbers up, all the discounted value that the company has generated in the past 20 years, plus the sale, and we get to a value of 56 billion. So essentially right now the company is selling at $57 billion. So that is fair value for 12% growth. But remember, we have this little buffer of a couple great years here, which could, lead to more growth. Let's increase this. So let's say they grow with the economy of 4%. I don't think that's going to be possible, but let's say they do. Then we are at 64 billion. They're worth, the company. So they are definitely. I think the company is fairly valued for a 12% return. But then you might get a couple percent dividends every single year on top of that. And if they keep buying back shares, and if they keep increasing the dividend, also if they just stop growing, right, they will maybe be able to provide you 12% a year through your dividends, because not that they're going to pay out a 12% dividends, but thinking about the number that you started with, if they buy back shares, then you might be able to get a 12% dividends on the initial investment. So there's a lot of good things to say about Maersk. I will say Intrinsic, I would say that it's about fairly valued, the company, for a good return. So guys, let me know what you think in the comments below about Maersk. I think it's a very interesting investment, and I'm actually getting employed in a company that a investment group, a holding company that they own, I think, or at least half of it they own. So that's like a supermarket. So I'm going to work for Maersk, and let me know down in the comments if I should spend my whole summer wage, the everything I'm going to make in the summer, because it's a horrible wage, on one single Maersk stock. That could be a possibility. Especially, it's definitely better than just spending it all. But this is 20,000 kroners. I don't know. That's probably like 1.5K, 2.5K dollars. So that's a lot. But we'll see, guys. I hope you enjoyed this video. If you did, make sure to drop a like, because it took a long time to make this slide. I'm going to keep you updated on Maersk. I think every year I'm going to make a video on Maersk every time they put out a new annual report. And I'll see you in the next one. Subscribe and have a great rest of your day. Peace.